The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
And welcome to Squawk Box. I'm Karen Cho with Sylvia Amaro, and these are your headlines. The sell-off resumes after a short-lived rally. Yields rise, the dollar weakens, and the Dow plunges another 1,000 points as President Trump's trade war fuels fears of a recession.
It's been amazing. We had a big day yesterday. There'll always be transition difficulty, but we had in history, it was the biggest day in history, the markets.
US inflation eases more than expected in March, the first month-on-month decline since 2020.
European Commission President Ursula von der Leyen eyes a hit on US tech if trade talks fail, warning potential retaliation could extend to service imports. And the Spanish Prime Minister Pedro Sánchez meets China's President Xi Jinping in Beijing, adding new impetus to their partnership amid the US tariff fallout.
TGIF, everyone. It's been quite a week, hasn't it? And just to summarise it, a chaotic week, almost like a comet for markets racing across the sky. Very brief moment where it effectively lit up the sky with that rally that we saw a day earlier, then burnt up very quickly as markets then reversed yesterday. But what are we left with on markets? So we have memes out there on social media. I think anyone on social has seen a meme of Trump working in a factory. Those are certainly doing the rounds. Yields on the edge of meltdown again as we go into that Friday session. Now, Trump did blink on his signature policy, and I thought the wash-up fascinating from a lot of international markets and commentators wondering whether this is now a negotiating tactic that other countries, as they still work out what those tariffs will be, now have some leverage here because they can see the pain threshold for Trump. Markets, that one-day rally, is it going to come back, or are markets now concerned that we've got further territory to explore to the downside? Plus, what are we left with when it comes to China? I think many are saying, look, this could be harmful for the US economy as we continue to see those recession signals that markets are concerned about. So it's been quite a week, hasn't it?
Quite a week. And it seems that one day we're here saying stock markets have rallied. The following day we're saying stock markets have sold off. So there's a lot of volatility on the table. I was actually reading about some of the reasons behind the rally that we witnessed earlier this week. Some suggesting that a lot of that was actually a short squeeze, and Bank of America suggesting that there could be more of that coming. So this volatility could be here to stay, really.
Well, we've used all those terminologies before, haven't we? Dead cat bounce, bull trap. I mean, I think everybody's trying to work out what type of market we're dealing with. But let's just recap some of those US numbers that we saw in session yesterday. I mean, the 1,000 odd points to the downside on the Dow, just extraordinary. 2.5% pullback, so now we're looking at a fifth negative session in 6. So over the course of the week, rather, it feels like a year. Over the course of the week, it's been to the tune of about 3.3% to the upside. So still some gains, bank stateside, but of course it's been more dramatic in some sectors, namely in technology. The Nasdaq in particular is where we're seeing fairly large swings. Yesterday, 4% plus to the downside, trading up 5% for the week, and of course that double-digit pop that we saw a day earlier. But to me, what went up in that earlier rally came down very quickly yesterday, and it was Nvidia, for instance, leading the charge lower for a lot of the major boards. Two treasuries. Now, I was just making the point that what we saw earlier in the week, Trump effectively blinking on his signature policy. Some were putting it down to concerns over the bond market, that we had meltdown taking place. And keep in mind what those yields were doing when Trump blinked. Very similar to what you're seeing on the boards today, 4.45%. So even though we came off a day earlier, we've gone back up again. And on those very long dated trades, the 30-year, you can see we're just 10 basis points shy of 5%. So some elevated levels there. The view is that perhaps there's some concern about holding US assets as a safe harbor, given some of the chaotic nature that we're seeing on decision making from the White House. To the dollar. Also a casualty over the course of the trade. And let's just take stock of where we stand this morning as euro and sterling both much higher. The dollar index for the trading week is down close to 2%, and this has been demonstrated against a lot of those pairs and crosses this morning. Dollar losing steam versus the Japanese yen that has marched up to 143, and versus the Swissy greenback is also on the back foot. And WTI and Brent, those recession fears have been knocking confidence from oil markets. As a result, for Friday, we trade below 60 on WTI, about 63 the handle for Brent. One of the clear trades this week has been gold. Much smaller ranges, but to the upside is what we've seen as investors have been seeking that safe harbour of bullion.
So let's get a check on what's happening in Asia so far this morning, how the moves in the US might have impacted some of the trades today in Asia. And we see further selling also for the Nikkei 225 at this stage. We are down more than 4%. A little bit of green for the Hang Seng and Shanghai Composite. However, the Kospi is also below the flat line at this stage. And this as we are continuing to track all the twists and turns in terms of trade tariffs from the United States. The White House has confirmed the effective tariff on China now totals 145%. That's taking the 125% tariffs President Trump imposed this week and adding the additional 20% fentanyl-related levy that he had previously announced. President Trump, meanwhile, welcomed the initial relief in the market after his tariff reprieve, but admitted that the transition towards America's new place in the global economy won't be easy. Trump also suggested his pause on tariffs could stay in place for longer than expected.
It's been amazing. We had a big day yesterday. There'll always be transition difficulty, but we had in history, it was the biggest day in history, the markets. So we're very, very happy with the way the country's running. We're trying to get the world to treat us fairly. This is something that should have been done 25 years ago, and it wasn't.
At the end of the 90 days, will you put those higher tariffs in place, or will you extend?
Well, that's what would happen. I mean, if we can't make the deal that we want to make, or we have to make, or that's good for both parties, it's got to be good for both parties.
You wouldn't.
And then we'd go back to where we were.
You'd go back to the numbers that you announced last week.
I think so.
You wouldn't extend the pause.
Yeah, we'll have to see what happens at that time.
So let's dig deeper and understand what's happening in Asia this morning with Lynn. Lynn is joining us now to break down all the market activity.
Yeah, good morning to you. So in terms of the Asian markets today, we are still seeing that broadly negative sentiment off the back of what we were just highlighting there in terms of the escalating trade war between the two largest economies. 145% is that number in terms of what the US is imposing on China there. So that is still a major concern. And let's focus in particularly here on the Japanese markets, because we are seeing that Japanese equities are the worst performer today. It is more than 4% lower on the session, keeping in mind that yesterday we did see a pronounced bounce back of more than 9%. Now, since all of this volatility has come about, we have seen particularly Japanese markets reacting probably in a more stronger way, whether that's to the upside or to the downside. I've asked some analysts about this, and basically it's down to a couple of factors, they tell me. The fact that Japan is one of the most easily shorted liquid markets in Asia. It is also one of the markets that open sort of first as well. So you've got a lot of these overseas macro funds reacting to some of the US trades, and sometimes that is then having that impact as well on Japanese equities. And then on the other hand, of course, is the Japanese yen. Of course, we've seen the sell-off in terms of the dollar, and then, of course, the bid coming through for the Japanese currency. We saw that during the US trading session. That's also flowed through as well to Asia trade session, and dollar yen at the moment, it actually crossed under that 143 level during trade today as well. But that also hampers a lot of the export-driven companies that are on the Nikkei 225. We're seeing that if you look through the heavyweights, for example, whether that's in terms of a lot of the chip-related stocks, but also I wanted to focus in on the number one in terms of weighting on the Nikkei 225, which is fast retailing, because it reported earnings and really instructive in terms of some of the things it was saying about how its outlook is now going to be impacted by these tariffs. They've assumed those higher reciprocal numbers for their outlook, and basically they're saying that for the second half of this year they see a 2 to 3% downside impact on their profit because of the impact on the North American market as well. So something quite instructive potentially for the future, guys.
Lynn, thank you very much for bringing us the latest from the Asian markets. Now, US inflation, it was welcome news, wasn't it? It did ease more than expected in March, falling to 2.4%. The core CPI print, meanwhile, came in at 2.8% year on year, its lowest reading in more than 4 years. So certainly good news for markets, but in the vein, of course, so we still had that drop. So you can imagine what we would have seen if we had a stronger CPI number yesterday. Energy prices fell more than 3%, while food prices were up 3% on the year. Shelter costs also rose sharply. Let's get to Alex Morris, President and CIO at FM Investments. Alex, it's been a tumultuous week again, but there's been a big debate around some market participants as to whether we've found a floor from here as Trump linked on that signature policy. What do you think? Is there any good news to extrapolate out from what we've seen in terms of these wild market moves?
Well, wild is maybe the easiest of the adjectives to use here. I mean, I find myself asking, are we having fun yet as we get started with these markets? And no, I don't think we found a floor. I think we have seen one very clear signal. The markets do not like these tariffs. They don't even like discussion of them. And every time there's some positive news, the market rallies 800 basis points. And when it's taken away, it rallies down 800 basis points. And markets don't like complacency, and they also don't like long periods of volatility, but they can continue to penalize investors by going lower and lower. And I think we're going to continue to see that until we have some actual resolution to this situation, which feels like it's going to be weeks or months away now, not hours and days like we had been promised under the negotiations in the heat of the moment.
It did feel as though the market would test Trump's resolve yesterday, and we certainly saw that in terms of the retreat on markets. I want to get into what's been won and what's been lost here, because it feels as though the game of confidence is being lost by Trump. He's losing businesses, investors. He is certainly not winning that confidence game. When it comes to the tariff side, though, he's made some claims that the US is now collecting $2 billion a day from tariffs. Some believe that is overstated if you look at the Treasury numbers. Is there a win at the end of the day here for Trump from this policy that has wreaked so much havoc?
Well, regardless if there is a win, and that $2 billion number seems overstated, particularly when tariffs are now, in some cases, going net down from where they might have been previously. But President Trump will find a way to claim a win, and the way out of this is for the world to find a way for President Trump to claim a meaningful win, even if it's not meaningful at all, so he can have a safe off-ramp, which is really the business of geopolitics and what I think the thing that investors have to look forward most to here. The rest of the world, the U.S. included, does need a good positive solution to this, and it may require everyone else coming together to help the U.S. find that solution, even if it can't find it itself. Because we don't believe for a moment that Donald Trump wasn't watching the equity markets. We appreciate the bond markets may have been the undoing of this round, but we're also aware that the rest of the world is watching the same things, and they're invested in these assets too. So there needs to be some resolution soon.
Alex, can we talk about inflation for a moment? Because it seems that the markets have stopped paying attention to some extent to the latest data. So far this year, we were all focused on all inflation prints, but yesterday it seemed that was just swept under the carpet. Where do we go from here in terms of what sort of data points the market is actually looking at?
Well, inflation is still important. We didn't lose sight of it. Certainly the Fed didn't lose sight of it, and they reminded anyone who was listening and agreed there just were fewer people listening to it. With all the noise and volatility and wild swings, it was hard to focus on the true fundamental data. But inflation did ease some. It didn't ease down to the Fed's target. The Fed has made very clear that all of this policy change, uncertainty, has added net to long-term inflation concerns, and they're not ready to blink yet or anytime soon.
I also noticed in your notes you're suggesting to not buy the dip. My question here is, what would it take for you to go back into the market to some extent?
We thought it didn't make a heck of a lot of sense to just run out. It's very easy to time the exit because you end the pain. It's really hard to time that reentry at the very bottom. We don't think, though, we've run out of steam yet. We don't think we've run out of steam on the bond market quite yet, although we do like still getting into the long bonds because we do think there's some natural floors that are going to emerge very soon. But I think we'd like to see some resolution with an initial trade deal with a large counterparty and a paradigm that we think can be spread to a handful of others. But that seems like we took a 90-day pause on that. We also don't know that 90-day pause is meaningful. This could end in a few days with a great announcement, particularly one from China, which we assume in the background there are conversations happening already. But this could also persist well beyond that. But that's the trigger we're going to look for, is some change in the geopolitics and some change in the tenor here in Washington, where it looks like we now have a plan and a path forward.
Alex, to that point as to whether this is a closing act that we're watching or whether we're still halfway through the show and at intermission, I mean, that is the hard part to assess. Bond markets, though, are sending their own messages here. And in terms of what we're seeing for the Friday session, we're marching back towards the 4.5% mark on the 10-year. Keep in mind, we were sub 4% last Friday's close. So that is a fairly large swing on that 30-year. We were at 4.4 almost by Friday last week, now marching back towards that 5% handle again. There is a view in markets that, look, it's not just a signaling function here, that you've had a lot of businesses that had to contend with the impact, the uncertainty of the tariffs, now them coming to force. On top of that, borrowing costs that could cause another squeeze. How do you think about the role of fixed income markets here for the economy?
No doubt that the fixed income market has played a very vital role now in how these decisions are being made and going to impact businesses, not just currently, but as they go to refinance debt that rolls off in the next weeks and months. We do think that the 10-year tends to find a floor around 5%. So we may have some room to go up, but we usually see a fair bit of cash. And let's not forget, there's still $26 trillion in U.S. money markets and bank deposits that can come pooling in at just the right moment. But we do think we have another 50 basis points of yield give before the floodgates start to open. But we do think the bond market cratering was one of the factors that drove Wall Street to fix this. And we try to remind investors that this is different than the GFC. The GFC was a markets problem that was resolved by government. This is a government problem that needs to be resolved by markets. And it's just much harder because it's hard for the markets to really get together at the right moment. There's a lot of profit taking that's going to happen. As you mentioned earlier, there's a lot of financial engineering and timing and short squeezes and all these other volatility and market moving items that can happen that governments generally don't engage in. So this is going to look messier before there is a resolution. But we are confident that Donald Trump blinked when the markets pushed quite hard, and that will happen again. But I wouldn't underestimate Donald Trump's resolve for more pain, which he seems to have very clearly signaled that we will need to endure before we get to the end of this situation.
He did highlight, however, that at least for the time being this week, he was paying attention at least to the bond market. So let's see what happened in the coming weeks. Thank you for your time today. Alex Morris, President and CIO at FM Investments. Now, the Amazon CEO, Andy Jassy, says he expects sellers on the platform to pass on the costs of tariffs to consumers. Jassy told CNBC that Amazon is closely watching for any change in consumer habits.
Such little data at this point since, the first set of tariffs came out and then yesterday there was a pause. But we have seen, we see people have not stopped buying, and in certain categories we do see a little bit of people buying ahead, but it's hard to know if it's just an anomaly in the data because it's just a few days and how long it's going to last. But we're going to do, as I said, everything we possibly can to keep prices low for customers. I'm guessing that that sellers will pass that cost on
fully.
Yeah, I think they'll try, and I understand why. I mean, depending on which country you're in, you don't have 50% extra margin that you can play with. So I think they'll try and pass the cost on. And as I said, it's so early right now, but we haven't seen any change in consumer behavior in a meaningful way yet.
And we'll continue to get the view from the White House when our colleagues speak to trade advisor Peter Navarro. That's coming up at 3 p.m. London time.
Also ahead on the show, Danes boycott US goods in protest against the Trump administration's push for US ownership of Greenland. We'll bring you the details next. Spanish Prime Minister Pedro Sanchez meets with Chinese President Xi Jinping in a bid to forge closer trade ties amid global trade tariff turmoil. More on that this hour. And we'll be speaking to Barclays head of European luxury goods research to discuss the impact of tariffs on the luxury sector. That's at 7:30 London time. Danish shoppers are turning their backs on the US-made goods. What supermarkets say is an act of protest against President Trump's positioning on Greenland and his sweeping tariffs. And it seems the boycott trend does not stop in Denmark. Let's get to Karen Gilchrist more. Karen, thank you so much for joining us. I know brands are fighting back. Volkswagen trying to put a little sticker, an import sticker on the cost on the windscreen. But it seems as though the Danes have gone even further. They're shopping by asterisk.
Yes, exactly right. This is a trend that we saw initiate in Canada with the pushback against the trade policies that came out there. And now we're seeing that trend move across to Europe and Denmark in particular. So this is somewhere that, of course, has huge trade flows with the US, but also has seen this posturing from President Donald Trump over Greenland. And this has sparked a really visceral reaction from a lot of consumers in Denmark who say, we're not having it. We're not going to have the US come and sort of make these claims over Denmark, which is, of course, a semi-autonomous Danish island. And they are pushing back. And there's various different supermarkets in the territory that are making it a little bit easier for consumers to make this choice. One particular grocery store group that runs 1,700 stores across not only Denmark but Poland and Germany, they have added asterisk labels to their goods to indicate that they're European made. Now, the CEO has said that this is in response to recent requests from consumers who have said that they would like to have a little bit more of an indication about these products from the EU, and that it's not, he says, not necessarily about boycotting, but many of the consumers that I spoke to on the ground say that this is something that they were sort of maybe making a choice on the basis of. One saying this is a bit of a screw you, in more choice words, to the US, and others saying, yeah, this is as looking to...
We're using all sorts of bad words these days on air. Thanks to the president.
But one of the store workers in particular said, this is just one of the few ways that consumers can make a little protest towards the US and say, actually, well, we don't want your goods if you don't want ours, sort of thing. So it's an interesting trend, and it's not only Denmark. As I say, started in Canada, and now we're seeing it elsewhere. There's some interesting polling from France that says around 1/3 of consumers are already starting to boycott products. And in Spain, we've seen the government also initiate a campaign to say, buy local, support your producers at home.
I guess this also goes in line with what politicians are saying to some extent. We are looking at the European Union also being more protectionist, really. Let's produce more in Europe, let's buy more in Europe, whether that's defense contracts or now goods.
Yeah.
I'm wondering also, where else are we seeing this trend? You've mentioned Denmark, you've mentioned France. Talk to us a little bit more about where there's more evidence in terms of this growing trend.
Yeah, well, exactly to your point. So the Spanish government has announced this kind of campaign which says our values are not for sale, but our products are. So it's very much reiterating that point that they want consumers to buy certain goods here. We've seen it also in various parts of Scandinavia, where I think this sentiment is very, very rife. They're just very frustrated with the president, and it's one of the few ways that they can push back. And we're also seeing it in, particular brands that I think have suffered especially. We've of course seen it in Tesla sales, so they've fallen dramatically. We've seen huge sort of vandalism of showrooms as well across various parts, as Germany, Sweden too. So you can see this sort of behaviour in action.
It's fascinating to see whether that continues, because don't forget, one of the big conversations this week was with the Michigan governor. That seemed to be the message that came back to Trump about the pain on auto workers. If this were to stretch a little bit further to some of the international brands, then you can imagine there would be consequences. Karen, thank you very much for the story. It is online if you want to read more from Karen's investigation on that European backlash to President Trump's policies. You can check out CNBC.com.
Now, a New York City Hall spokesman has confirmed a man killed in a helicopter crash in New York's Hudson River as the president of Siemens Spain, Agustin Escobar. His wife was also identified among the victims alongside the family's 3 children. NBC's Jay Gray filed this report.
The sightseeing chopper appears to break apart, losing pieces of the rotor and tailpiece as it drops into the Hudson.
I heard like a weird noise, and when I looked up, I just saw it falling from the sky, and then just saw a big splash in the river.
Divers rushing into the water and wreckage within minutes of the crash, firefighters and police staging along the shoreline, but quickly realizing there are no survivors.
At this time, all 6 victims have been removed from the water. And sadly, all 6 victims have been pronounced deceased. Again, we're praying for the families and our gratitude to the rescuers and the courage that was displayed.
5 of those victims, 2 adults and 3 children, tourists reportedly from Spain. The 6th, the pilot. First responders overwhelmed by the loss.
They told us they did everything they can to try to save these victims, and you can see the trauma in their face. They did everything they can.
The Jersey City Office of Emergency Management on the west side of the river has secured what's left of the chopper and will work alongside a team from the NTSB, the lead agency in the investigation. Jay Gray, NBC News.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.